In March of 2009, Warren Buffett wrote a public op-ed in the New York Times telling Americans to buy stocks. The market had just fallen 57%. Unemployment was climbing past 8%. Every headline was predicting a decade of stagnation. He was not being contrarian for attention. He was operating from a framework that separated the mechanism of compounding from the emotions surrounding it. The people who read that op-ed and did nothing walked into one of the longest bull runs in American history with their hands in their pockets. Most investors assume that staying invested is enough, that patience alone is the strategy. But patience without structure is just hope with a brokerage account. Here's the question that does not get asked often enough. If compounding works in both directions, what exactly is protecting you when the acceleration runs the other way? That is the mechanism at the center of this video. And if you do not understand how losses compound differently than gains, every correction you live through costs you more recovery time than the drop itself suggests. Not weeks, years. My name is Alex, and if you have ever held through a painful drawdown and still felt like you came out behind, pay attention to what comes next, because the issue is rarely the asset you picked. I'm going to show you exactly how the asymmetry of losses quietly extends your timeline and the 3 specific moves that prevent a crash from resetting years of progress. Once you understand how compounding actually behaves under pressure, you will stop measuring your portfolio by the headline drop and start managing the number that actually matters, how long it takes to get back. That recovery window is determined long before the crash arrives. And to understand why, you need to look at what the market is signaling right now, because the current setup has some very specific pressure points that are worth knowing before things move. Put a number like 94 on something, and most people assume it is a test score or a percentile ranking. In this case, it is a price-to-sales ratio, and the company associated with it is about to go public for the first time. SpaceX is hitting the market this week at $135 a share, targeting a valuation of $1.77 trillion. Their revenue last year was $18.7 billion. That puts them at roughly 94 times annual sales. For reference, a healthy price-to-sales ratio typically sits under 2. Anything above 4 is considered stretched. Tesla, at its most euphoric peak, traded around 25 times sales. SpaceX is coming to market at nearly 4 times that level. That is not a growth premium. That is the market collectively agreeing that this company will execute perfectly, at scale, for years without interruption. No missed quarters, no unexpected costs, no surprises. The margin for error priced into that valuation is essentially 0. And when the margin for error is 0, every piece of bad news lands harder than it normally would. 5 days ago, a piece of bad news arrived. The May jobs report came in at 172,000 new non-farm payrolls added. Economists had forecast somewhere between 80 and 85,000. The labor market more than doubled expectations in a single data release. On the surface, strong hiring sounds like good news. For most workers, it probably is. But for anyone watching interest rate policy, it immediately changed the picture. A labor market. This resilient gives the Federal Reserve no reason to cut rates. Within hours of the report, the probability of a rate hike by December jumped to 68% on the CME FedWatch tool. 2-year Treasury yields climbed roughly 10 basis points in a single session. Think about what that means for every asset priced on future expectations. When borrowing stays expensive, the present value of future earnings falls. When short-term government bonds are yielding 4% with almost no risk, institutional capital starts asking a straightforward question. Why hold equities priced for perfection when safer alternatives are paying real returns? That shift does not happen overnight, but it is already happening. Slowly, quietly, at the scale of trillions. Then there is the energy situation. The Iran conflict has kept oil prices well above pre-war levels for months. Brent crude spiked as high as $126 a barrel in late April, when the Strait of Hormuz disruption was at its worst. It has pulled back somewhat since ceasefire signals emerged, currently sitting around $90, but the strait remains effectively closed. Oil feeds into everything: manufacturing costs, shipping, consumer prices, and elevated energy keeps inflation from cooling the way the Fed needs it to. And the AI trade, which carried so much of the market's optimism through the past 2 years, is showing its first real cracks. Broadcom's recent earnings dragged the broader semiconductor space lower, as investors signaled they are no longer willing to reward spending promises without matching results. The easy part of the AI rally, where anticipation alone moved prices, appears to be over. On the calendar, 3 dates are worth watching closely this month. The CPI inflation report today gives the first read on where consumer prices are moving. The Fed meeting on June 17th will be the first press conference under new chair Kevin Walsh, and whatever tone he sets on rate cuts and future projections will move both stocks and bonds. Then on June 27th, the core PCE data lands, the Fed's preferred inflation gauge, and likely the last major signal before summer. Beyond traditional markets, the stress is showing up in places that would have seemed unlikely 2 years ago. Strategy, the company formerly known as MicroStrategy and one of the loudest corporate Bitcoin advocates in the market, sold 32 Bitcoins last week, just $2.5 million, to fund a preferred stock dividend payment, small in dollar terms, large in what it signals about the pressure building inside leveraged crypto positions. And JP Morgan, Bank of America, and Citi announced plans to build a shared tokenized deposit network by mid-2027, operated through the clearinghouse. The mechanism is straightforward. Stablecoins are threatening to pull deposits outside the regulated banking system, so the banks are building a digital alternative that keeps capital inside their walls. It is not idealism, it is defense. Follow the incentive, and the move makes complete sense. That is the environment sitting underneath your portfolio right now. Multiple pressure points, all tightening at the same time, and all of it sets the stage for exactly the kind of volatility that exposes a gap most investors do not know they have, because the brutal math of compounding in a downturn works nothing like they were taught. Most people think a 40% loss requires a 40% gain to recover. That assumption is wrong, and the gap between those two numbers is where years of progress quietly disappear. Here is the actual math, and it is worth walking through slowly because it does not behave the way intuition suggests. Start with $10,000. In year 1, the market returns 10%. You are now at $11,000. Year 2, another 10%. You are sitting at $12,100. 2 clean years. Compounding does exactly what it promises, building on itself, accelerating quietly in the background. Then the market drops 40%. Your balance falls to $7,260. Not back to $10,000, not back to $11,000. $7,260. You have not just erased the gains from 2 good years, you have taken a significant chunk out of the original capital you put in. And here is the part that catches people off guard. To climb from $7,260 back to your previous high of $12,100, you do not need a 40% gain. You need 67%. That is not a rounding difference. That is the math of asymmetry, and it is working against you every single time the market falls. A 40% drop is not hypothetical. That is roughly what the S&P 500 lost during the 2008 financial crisis. The Dow fell more than 50% from its October 2007 peak to its March 2009 low. It then took over 5 years for the index to reach new highs. 5 years of contributions, 5 years spent climbing back to zero. For an investor who was 42 in 2007, recovery arrived when they were 47. That is 5 years of compounding that worked entirely in reverse before it could start working forward again. Let me put a face on that. Picture a 39-year-old pharmacist named Claire. She had been investing since her late 20s, consistent and disciplined. By late 2007, her portfolio sat at $116,000. Diversified index funds, automatic contributions every month, no individual stock picking. She had done everything right. Over the following 18 months, her balance fell to around $57,000. She did not panic immediately. She held through most of the drop, telling herself she was a long-term investor, and this was temporary. But as the losses deepened and the headlines got darker, something shifted. The gap between what she knew intellectually and what she felt emotionally kept widening. In February 2009, she moved 60% of her remaining balance into a money market account to stop the bleeding. The market bottomed the following month. She missed most of the recovery. By the time she felt confident enough to move back into equities, the S&P had already gained over 40% from its low. Claire did not lose because she picked bad assets. She lost because the math of compounding in reverse applied pressure that her original plan was not built to absorb. This is the part worth sitting with. Compounding is not a safety net. It is a multiplier. And multipliers do not check which direction they are running. In good years, they accelerate your gains. In bad years, they accelerate your losses. The same mechanism that grows $10,000 into $12,100 over 2 years is the same mechanism that takes $12,100 down to $7,260 in 1. What makes this especially dangerous right now is the context from Section 1. A market with stretched valuations priced for perfection, rising rate pressure, an energy disruption, and AI earning scrutiny as a market where the conditions for a significant correction are more present than they have been in several years. The direction is not certain. The existence of risk is. And if the math of a crash is brutal, the human response to it is often what turns a temporary loss into a permanent one. Because the instinct most investors reach for when their portfolio starts falling, the urge to get out, to stop the pain, to wait for safety, is precisely what the cost of missing out punishes most severely. The single most expensive financial mistake most people make does not happen when they pick the wrong stock. It happens in the 48 hours after their portfolio drops 10% and they decide they have seen enough. The instinct to sell during a falling market feels like protecting what you have built. But the data on what actually happens to investors who act on that instinct is one of the most consistent findings in all of personal finance. And it is not encouraging. First, let's be clear about what you're actually dealing with when a correction arrives. Market drops are not rare events. They are not once-in-a-generation catastrophes that justify exceptional action. A correction of 10% or more happens, on average, once every single year. A bear market of 20% or more arrives roughly every 4 to 6 years. A major collapse of 30% or more, the kind that dominates headlines and feels like the world is ending, happens roughly once per decade. If you are investing for any meaningful length of time, you are going to live through all of these, multiple times. That is not a risk to be managed, it is a schedule to be planned around. Now here is where the numbers get uncomfortable. Fidelity tracked a $10,000 investment in the S&P 500 over 4 decades, from 1980 to 2022. If you simply left that money alone across the entire period, it grew to $182,000. Remarkable, and entirely passive. No decisions required, no monitoring, just time. But if you tried to sidestep the pain by moving to cash during the worst stretches, and in doing so missed just the 5 best single trading days out of more than 10,000 total trading days across that period, your outcome dropped to $67,000. Not slightly lower, more than 60% lower. Gone. From $182,000 to $67,000 because of 5 days out of 42 years. And if you missed the 50 best days, which sounds like a lot until you realize that 50 days across 10,000 is less than 1%, you walked away with $7,600. You would have been better off putting the money in a savings account in 1980 and leaving it there. $7,600 versus $182,000. Same starting amount, same index, same time period. The only difference is whether you were in the market on the days that mattered most. Here's what makes this even harder to navigate in practice. Those best days do not happen during calm, confident markets. They happen during chaos. According to JP Morgan research, 7 of the 10 best single-day returns in S&P 500 history occurred during or immediately after the 2008 financial crisis. The very moments that trigger the strongest urge to sell are statistically the moments most likely to precede the sharpest recoveries. Think about what that means concretely. A 53-year-old accountant named Robert watched his portfolio fall steadily through late 2008. He had been invested for 20 years. He knew the theory. He had told clients in his own professional life that long-term investors should stay the course. In January 2009, with his balance down nearly 40% and every major bank still reporting catastrophic losses, he moved to cash. He told himself he would get back in once things stabilized. He got back in 12 months later, after the market had already recovered a significant portion of the bottom. His 20 years of disciplined investing produced a fraction of what simple inaction would have delivered. He did not fail because of ignorance. He failed because knowing the right thing and being structurally prepared to do it when it counts are 2 completely different conditions. That gap, between understanding the theory and having a system that survives contact with real fear is exactly what the 3 steps to prepare now are designed to close. Because staying invested is not a mindset, it is an architecture, and you build that architecture before the crash arrives, not during it. The architecture of a crash-proof portfolio is simpler than most people expect. Not easy to build emotionally, but structurally simple. It comes down to 3 specific things, and none of them require predicting what the market is going to do next. The first one sounds obvious until you look at how few people actually have it in place. A genuine cash cushion. 3 to 6 months of your full living expenses. Not a stripped-down survival budget, your actual monthly spending. Sitting in a high-yield savings account that is completely separate from your brokerage. Currently, the best high-yield savings accounts are paying between 4 and 5% annually. That rate has come down from its peak as the Fed held rates steady through the first half of this year, but it is still meaningfully above zero and meaningfully above the national average savings rate of 0.38% sitting in a traditional account. Your emergency fund is not supposed to make you wealthy. It is supposed to make sure that when life gets expensive at the same time the market gets ugly, and those 2 things have a habit of arriving together, you never have to sell a single share to cover it. Picture a 37-year-old logistics manager named Teresa. She had been investing steadily for 9 years, with good allocation, low-cost funds, and automatic contributions. No emergency fund, because her investments felt liquid enough. When her company restructured and eliminated her position in early 2023, she needed 4 months of income while she found her next role. Her portfolio was down at the time. She sold $28,000 of index fund holdings at a loss to cover her expenses while she searched. She found a new job. The market recovered. But those $28,000 sold at the bottom were not there for the rebound. The emergency fund was not a wealth-building tool. It was the thing that would have kept her compounding intact. It did not exist, so the market timing was decided by her landlord and her grocery bill instead of by her investment plan. The second pillar is automating your contributions through dollar-cost averaging. The mechanism is straightforward, but the implications are more powerful than they first appear. You invest a fixed dollar amount on a fixed schedule, say $300 every 2 weeks, automatically transferred from your checking account into your brokerage and deployed into your chosen index funds. In a flat market, that $300 might buy 12 shares at $25 each. When the market drops 40%, that same $300 automatically purchases 20 shares at $15 each. Your buying power increases exactly when prices are lowest. You are accumulating more of the asset during the crash than you were during the calm. The automatic part is doing most of the work, because the value of this system is not the math. It is the removal of the decision from the moment of maximum fear. The purchase executes whether the headlines that morning are neutral or catastrophic. You made the rule when you were thinking clearly. The system follows it when you cannot trust yourself to. That is the architecture working as designed. The third pillar is true diversification, and this one deserves a more precise definition than it usually gets. Owning 6 different technology stocks is not diversification. Owning 4 funds that all track U.S. large cap growth is not diversification. Real diversification means spreading capital across asset classes that respond differently to the same economic conditions. A broad U.S. equity index, international developed markets, emerging markets, investment-grade bonds, real estate investment trusts known as REITs, which give you exposure to property income without the concentration risk of owning individual properties. When domestic equities are under pressure from rising rates and stretched valuations, which describes the current environment with reasonable accuracy, international markets and bonds often hold steadier, cushioning the overall drawdown. And this structure gives you something tactical. It allows you to rebalance on a schedule. Once a year, or when any allocation drifts significantly from its target, you trim whatever grew and add to whatever fell, mechanically, without emotion. That single rule, applied consistently, forces you to buy low and sell high in every cycle, not because you called the market correctly, but because the system did it for you. 3 pillars. Each one is doing a specific job. Together, they change the question from whether you can hold through a crash to whether anything could structurally force you not to. But here is what all 3 of these steps cannot fully protect you from. Because the investors who blow up their long-term returns often do not miss a cash cushion or a rebalancing schedule. They are defeated by something older and harder to design around. And that is where defeating your own psychology becomes the final and most critical layer. There is a fund that delivered an average annual return of 29.2% over 13 years. To put that in perspective, the S&P 500 averages roughly 10% annually over the long run. This fund nearly tripled that. It is one of the greatest long-term track records ever recorded by a single portfolio manager, and a significant portion of the people who invested in it lost money. That is not a typo. Same fund, same manager, same returns. Negative outcomes for a large share of the people who are actually in it. The fund was the Fidelity Magellan Fund, managed by Peter Lynch from 1977 to 1990. Lynch himself noted the pattern and was openly troubled by it. Investors would read about the fund's performance, buy in after a strong run, watch it pull back as all funds do, panic and sell, then repeat the cycle with the next hot entry point. They had the right asset. They had one of the best managers in the history of the industry. Their own behavior destroyed the outcome. This is loss aversion in its most expensive form. Loss aversion is a behavioral phenomenon, documented by psychologists Daniel Kahneman and Amos Tversky, whose research on human decision-making under uncertainty eventually earned Kahneman a Nobel Prize. Their core finding was precise. The psychological pain of losing a given amount of money is roughly twice as powerful as the pleasure of gaining the same amount. Losing $1,000 hurts approximately twice as much as gaining $1,000 feels good. The experience is fundamentally asymmetrical, and no amount of financial education makes it otherwise. This matters because it means that when your portfolio is falling, the emotional pressure you feel is not proportional to the actual loss. It is amplified. A 10% drop does not feel like 10%. It feels like the beginning of something much worse. And in that state, the rational understanding that you have a plan, that crashes are temporary, that selling locks in the loss permanently, does not stand much of a chance against a feeling that is hitting twice as hard as any comparable gain ever did. The Magellan investors were not irrational people. Most of them understood, in the abstract, that markets go up and down. But understanding something in the abstract and experiencing it in real time with real money are two different cognitive events. When the drop arrived, the pain overrode the plan. Every time. Here is what makes the current moment particularly worth paying attention to. The conditions in place right now, stretched valuations, rate uncertainty, and ongoing energy disruption, the first major Bitcoin sell by one of its loudest corporate advocates, are precisely the kind of multi-front pressure that activates loss aversion at its strongest. It is not one bad headline. It is several, arriving at the same time, all pointing in the same direction. That combination is what makes even disciplined investors start questioning their framework. Think about a 44-year-old marketing director named Grace, 15 years of consistent investing, a genuinely diversified portfolio, an emergency fund, automatic contributions in place. By any measure, she had built the right system. But in late 2022, when her balance had dropped nearly 22% from its peak, and the headlines were relentless, she found herself checking her account 3 times a day. Then she started researching when to move to cash. Then she actually did it. Not all at once, but gradually, which is often how it happens. Not a single dramatic decision, but a slow erosion of the plan, driven by a feeling that kept intensifying each time she looked at the number. The system she built was correct. The biology defeated it anyway. The solution is not to pretend you will feel differently in the next crash. You will not. The solution is to make your decisions before the crash arrives, and then make it structurally difficult to override them under pressure. Write down what you own. Write down why you own it. Write down exactly what your response will be when your portfolio falls 20%, 30%, or 40%. Not what you hope your response will be, what it will be. Specific and committed. That document becomes the anchor. When fear is loudest, you are not making a new decision. You are executing an old one, made by a version of yourself who is calm, informed, and thinking about decades rather than days. The final question worth leaving yourself with is a simple one. When the market inevitably drops, and it will your financial future be shaped by a temporary feeling or by a permanent written plan? Here is what this video actually came down to. Compounding is not your safety net. It is a multiplier. And multipliers do not care about your intentions. They amplify whatever direction the market is moving, including the wrong one. That is the mechanism most investors never see clearly until they have already felt it. A few things worth carrying forward. Losses compound faster than gains recover. The best market days happen during the worst moments. Missing them is permanent. The emergency fund is not savings. It is the thing that keeps you from being forced to sell at the bottom. And the written plan is not a document. It is the only version of you that can make a rational decision when fear is running the room. Watch for the moments when doing something feels more responsible than doing nothing. That feeling is almost always wrong. The question this raises, and it is worth sitting with, is whether the same psychological forces that destroy individual investors during a crash are also quietly shaping how institutions behave during one. How the fund managing your money responds to volatility, and whether their incentives actually align with yours, is a different and darker conversation. If this landed, share it with someone who checks their portfolio too often.